Hey, Bulls and Bears. My name is JJ. You're watching Bull, Boom, Bear, Bust. Thank you for joining me. Today is December 1st. It is Thursday. Putting this out a little bit later in the evening. Most of you, probably a lot of you, are watching this on Friday, which is December 2nd. Either way, thank you very much for being here. We've got a lot of economic, financial news here to get caught up on here, and I want to give you my take on some things that we're seeing happening in the economy. And we want to go back and cover a few things that we've talked about here over the past year or two specifically. So let's get started right here. The labor shortage. We remember seeing signs up, a lot of help wanted signs. Even now, still a lot of help wanted signs are up. And it seems like that these places had a hard time finding people to work, especially entry level jobs, right? Low wage, beginner, entry level jobs, minimum wage jobs, fast food, and the like. And a big part of that, I think, was the gig economy, right? A lot of people out there being a creator, kind of like this channel right here, but even people much bigger than myself, people making money doing their own thing. And what that does, that draws viewers away from what we call legacy media, from the main, the big major networks. And now we're seeing this in a lot of layoffs. We see AMC. Oh, actually, I've got an update on that. I posted a correction, 2 videos ago, where I talked about layoffs at AMC, and I started going into why I don't go to the movies much anymore, the cost of popcorn, etc. That was actually AMC, the TV channel, right? So I messed up a little bit there. But AMC, the theaters, have also had layoffs in recent history. But this particular article that I pointed to just a couple reports ago was about AMC, the TV network, which does have some other channels, TV channels, cable channels under the same umbrella. They are laying off. Now, this announcement today, CNN is laying off staffers. CNN laid off hundreds of staffers as part of a broader Warner Brothers Discovery effort to cut costs. So a lot of people are tuning out from what's called legacy media, these major cable news networks, these multinational, companies, and they're tuning into shows like this. I mean, not my channel, but shows like this. I mean, I have a little bit of viewers here, not many. I'm kind of a small channel, but overall, a large number of people are going to alternative media. I was going to say alternate, which it is. It's an alternate to the what's called the corporate media, but alternative media is what many people call it. And the creator economy, people putting out their own information on YouTube, giving their own take on things, putting out their own opinion. And that's become very, very popular as a source of income because a lot of these platforms have advertising. So it's interesting to see this shift away from the major news networks over to this alternative media. And I think a lot of the labor shortage ties in with that, because a lot of even younger people now are starting up their own channels. They're filming. They're making money on the side, or not even on the side. In some cases, it's the main source of income for a lot of people. So I think that's a part of the labor shortage. Also, minimum wage doesn't get you very far nowadays. So I think a lot of the people that normally would have moved out and attempted to get their own apartment or own home just ended up staying at home and not working. Maybe spending another year or two in college, especially when you don't have to pay back your college loan. Why not, right? It's almost like a free ride, as many people would look at it. But let's get into some more information here about this deteriorating economy. More layoffs. We just talked about one. More failures. A mortgage company goes under. Mortgage firm files for bankruptcy amid housing market deep freeze. That's out of Bloomberg. This was a reverse mortgage company, and that was also put out on a few different websites, a few different news media outlets, called reverse mortgage funding. Reverse mortgage funding. Gosh, I can't talk today. H&M also 1,500 layoffs. Kraken, the crypto exchange, basically slashing a lot of jobs, 1,100. DoorDash, 1,250 layoffs. There's the AMC one again. That's the AMC TV networks. That was about almost 400 people laid off there. Hewlett Packard, about 4,000 layoffs globally. So I'm seeing a lot more layoffs. We continue to see mortgage firms going under, even though mortgage rates took a drop here over the past few weeks. It's not enough of a drop to really breathe a new life into the housing market. We also talked a few reports ago about how Rich Dad, Poor Dad author Robert Kiyosaki's out there saying, God help us all. Obviously, he sees something very serious and very dire on the horizon for this economy. If he says something like "God help us all," he's been sounding the alarm for a long time. So it doesn't mean that something's drastically going to happen, but we are seeing the signs that things are headed back south. Now, 2020 was kind of even though it was a pandemic and it was bad for a lot of people, lockdowns and things like that, job losses. It was also a period of kind of a reset because so many people didn't have to pay their bills during those years and got extra money, and savings actually increased. Now we see the savings rate for most Americans has plunged back down to pre-pandemic levels, and very far below pre-pandemic levels, all the way down to financial crisis levels, right? So things are not good when you just dig under the surface just a little bit. Of course, they want you to keep spending. They want you to keep going further into debt and shopping so they can continue to make their income at these big companies and report their profits. In the meantime, a strong economy is measured by how much debt people can accumulate and how far they can go into debt and how many credit cards they can swipe. That's known as economic growth, as far as the powers that be actually measure economic growth. Another article here: home sales collapse, and home sales will continue to collapse through 2023 unless we see a tsunami of desperate owners putting their home on the market. That could actually increase sales somewhat, even though prices may still continue dropping, because you're going to have a lot of owners that are going to be, they already are in a lot of debt. And a lot of these owners are going to get further into debt. Just the cost of living, the cost of maintenance on their home, just everywhere you look, everything's higher. The Fed's out there talking about slowing down the rate of rate hikes, which is interesting because inflation is still about at a 40-year high. So why would they be talking about slowing down the rate hikes? If rate hikes were the answer, again, I have to say this every few reports, if rate hikes were the answer, why just do fractions of a percent? Why not go up to 7, 8, 9, 10% immediately? Why? Because debt would implode. All the people carrying this debt, their budgets would implode, and it would be a disaster. So that's the reason why they haven't hiked them faster, even though they're telling us that higher rates are the solution for inflation, which we all know is not true. It's a supply and demand issue, and we don't have enough manufacturing. And if we did, prices wouldn't be as high as they are now. And it's interesting when we see banks come out and give warnings on the economy. It's usually a week or two before a Fed meeting. And one of the people down in this channel and comments down in this channel had said banks likely put that out there before the Fed meeting so they can remind the Fed or maybe even urge the Fed to not raise rates so much. But again, banks are the winner either way. Higher rates, lower rates, banks always win. Banks actually make money when you're broke because they get more late fees, they get more overdraft fees. Some banks have stopped giving out fees for those things. Not all of them, but some of them have. So it's a little bit of good news that we see out of the banking world. Bank of America warns of hot inflation and that it might run rampant for another 10 years. Another 10 years. Wow. So another warning out of Bank of America. We saw a warning out of, was it Citibank, that we're going to see a tsunami of recessions, or what do they call it? They said a rolling recessions globally. And just because these banks are out there giving warnings doesn't mean that it's going to happen, immediately or tomorrow. But we do see this continuing stress with the bulk of the U.S. population, what we call the consumers, and the bulk of the middle class. Most Americans now living paycheck to paycheck. And it's just going to get worse. Inflation's not coming down altogether. You may see a spot here and there, but overall, still buckle for what is coming, folks. Strap it in, buckle up, whatever you want to call it. Hope everybody liked this report. Thank you so much for being here. We're going to wrap this up. Talk to everybody very soon. Please come back to the channel if you like what we talk about. Give us a thumbs up and a subscribe if you'd like to keep us on the air. Appreciate every one of you. Thanks for being here. Bye now. Bye now and peace.